advisory firm. We do commodities and energy markets. So we're in power, oil, natural gas, agriculture, biofuels, maritime shipping. So these are all different product arms that we do offer. Obviously today we're mainly going to be talking about power, but if you have any interest in seeing what we provide for oil or our natural gas side, please let us know, and we'll reach out to you with the necessary information for that. Speaking specifically about what we do offer on the power side, this is one of our main products here. This is a real-time map. You can see the United States there. And we do have monitors on multiple power plants, transmission lines that run through the United States. And we are able to monitor power flows, power generation in the real time. This is proprietary Genscape data. This is not offered by anybody else. As you can see here, 25 of the top 25 power buyers and sellers use Genscape. We have EMF monitors, IR, infrared, and we do offer frequency events as well for real-time traders. So we do alert you when a plant is coming down, if something trips offline, long before anybody else can offer that. Monitors 480 of the largest plants in the U.S., 1,500 key transmission lines, all watched in the real time. The other major product that we do offer are price forecasts as well. We're in all of the major markets, PJM, MISO, ERCOT, NEPOOL, NYISO, CAISO, and WEC. We also have recently added FPP as well. We do day ahead, 24 hours, real-time pricing forecasts as well. Very strong correlation. We have a proven track record here. Upside, downside scenarios by cell. We also provide not only the reports that are available online. We send you blasts over AIM. I do daily calls with clients individually so they can ask me questions offline. I can run custom scenarios for them. We also offer XML data feeds so you can get the information a little quicker, pull the data into your system, and combine our forecast with yours to just kind of give you a little more clarity of pricing for power for pretty much all of North America there. So the agenda for this outlook, first we're going to cover just what happened this fall, you know, just the demand, the interface derates, everything that happened. We're going to go over what happened last winter. I'm sure that's still fresh in everybody's mind, but we're just going to go over what happened, what the drivers were, what drove price in New York. Then, of course, we're going to cover this upcoming winter outlook. We do have demand to cover. I'm going to go over the weather. And then a little deeper dive, look at some congestion, some outages, import-export expectations, gas, oil outlooks. Then I'm also going to cover a product, Power Buyer, just specialized in real-time versus day-ahead buy-sell options. And it is a great way to kind of manage your risk if you are buying or selling power in the real time you're choosing between the two markets. It's a tool designed specifically for people making those decisions. Also, anybody doing virtual trading, anything like that, I believe will find it very useful. One more piece of housekeeping before we get into this. All the prices and all the values are represented day ahead on peak average unless I otherwise say so. So just calling back on what we were expecting coming into this fall, we did call for strong IMO imports. There was actually an unplanned D-rate coming through. It was listed around 1,200 for back to Niagara. They ended up not only extending that D-rate or extending that outage, but the D-rate was actually 900, 700 at some point. So that did end up limiting that IMO flow before or below what we were expecting. Strong exports out to ISO New England, over 600 megawatts on peak average, what we were looking for. Actual was just around 1,600. In line with our forecast, would have been much stronger, but again, there was a D-rate on that New England AC system, so that did limit flow. D-rates on Central East, we were looking for that to drive strong upside FK congestion. That did occur over this fall. We were looking for some increased Zone A volatility due to an outage at HQ. Thought that would increase the pull on Niagara, increase the pull on IMO, drive some of that upside Zone A congestion we have been seeing. While there was some volatility seen when HQ first went down, as back to Niagara went out, it did limit those IMO imports below 900. And with weak IMO flows, we did not see strong congestion as the thermal limits on the 345 kV system out there were not pushed as much as we were originally anticipating. We did see a derate of the TGP pipeline, we did think that would drive strong gas, increase the exports out to New England, and that did come as expected. Looking into demand, warmer than average, matched our expectations. The warm anomalies did go a little further north than we were expecting. September was actually the very strong peak load day. Technically did not fall in the summer, but actually was stronger demand than any day of the summer. Came in on the 2nd there, so that obviously skewed the data for September. For October, warmer than average once again, wetter than average. And for November, it does start to cool down as we do and get into the winter a little bit there. Overall, this was in line with Genscape's expectations. And I'll get into our meteorology and our forecast a little later in this webinar. Quick look back at some more price drivers over the fall. We did have some HQ outages, IMO derates, as I mentioned, New England derates as well. There are the dates. Looking at them a little more specifically and the effect that they did have on New York, we do see an outage here on HQ. You can see the total imports on HQ is represented there in the blue line. Red line is reference pricing, so that is that Marcy price. Rather than using any particular zone, which can be affected by congestion, just showing the reference here, we can see clear upside to the reference when HQ is down. I mean, this is as to be expected. Without about a gig of imports, obviously prices are going to increase a little bit. IMO and Zone A congestion. So as we said previously, Zone A congestion did end up being limited by those IMO imports during the derated period. So strong IMO imports we see are highly correlated with that Zone A congestion if you look back in September. And then as those IMO imports do come down a little bit, down to around 600, we do see that Zone A MCCs pretty much fall out. Then as IMO imports do spike back up around October 27th, where I'm looking here up to around 1,200 again, we do see that Zone A congestion return. Again, this is day ahead. And I think we are seeing a similar scenario over the last few days, mainly in the real time, getting some spikes out there in Zone A as IMO is coming in well above schedule, as that outage at back to Niagara has been relieved. New England derate and the drivers of congestion in Zone G. As we can see, we have no Zone G congestion when New England AC exports are at 0. So once again, just a major driver of the upside to the east of the state. And we see a strong correlation with pricing and the derates that came through during this fall. So now we're going to take a look all the way back to what happened last winter, try to get a sense of what really drove those prices, and then we'll play that into what we are going to expect for this upcoming winter. So as I'm sure we are all aware, winter 2013 through 2014 saw much cooler than average temperatures. Each month was much cooler than average. January and February were well below average. Significant events, obviously the polar vortex, several 2 to 3 day periods in January and February, highs in the teens and lows in the negative 20s. Very, very cold across most of northeastern America, but obviously specifically New York, New England, obviously PJM was affected as well, and Canada, which we will get into. So quick winter review, looking at heating degree days, we can see that there were actually slightly less heating degree days than average in December, but then getting into January and February, especially out there in that Buffalo region, out there in the west of the state, and in the west and in the Midwest, we saw well below average temperatures, well above average amounts of heating degree days. So that obviously drove very strong, not only power demand, but primarily very strong gas demand as well, which was another upside driver to the New York power market last winter. We did receive a record winter peak. We can see here on the 28th of January, Zone G day ahead cleared $463. So that was the peak pricing that we saw. That was slightly removed from the actual winter peak, which was on the 7th during that first cold snap. You can see we did see strong pricing across the grid, but nothing compared to what happened at the end of January. Again, that was driven by the strong gas prices we did end up seeing. So the new winter demand peak is 25.7. Here's a look at the 4 main gas hubs that we will look at for New York. Z2 coming in from the north. Algonquin doesn't really directly affect the New York gas market. Obviously, it does affect the New England gas market, flows out to New England, and is often used as a bit of a proxy to represent the state of northeastern gas markets. Z6, very strong year-over-year. TECO M3, obviously showing the largest year-over-year variance. As I mentioned previously, the polar vortex hit the entire Midwest as well. PJM driving up gas and heating demand there. Looking at import-exports once again through last winter, we can see that when there was extended periods of cold in Montreal, the blue line here representing the average temperature, we see net flow dip down. So when we have extended periods of average temperatures below 0, this is in Fahrenheit, below 0 Fahrenheit, we do actually see a reversal of flows back up to Canada. So the slide that I was showing you previously that showed the effect of the reference price when we lose those imports, you can imagine that's exacerbated when we're actually exporting to Canada. So keep an eye out for that this winter as well. Going into the winter and demand outlook now for this upcoming winter. So overall, we are expecting it to be cooler than average. There's going to be a very cold winter, but one thing that is very important is not expected to be as cold as last winter. We are not expecting a similar polar vortex situation. It will not be the dominant force, so the colds will be less extreme, slightly more consistent. So once again, it will be strong demand. We'll likely see some upside gas, but not expecting the same magnitude for New York, nor Canada, nor the Midwest, as we did see last winter. So looking for 1 to 2 degrees colder than average, temperature-wise, 25 to 50% drier than average as well, especially out there in the kind of northwest of the state. So that'll just add to the coldness. So the expectations, overall heating degree days will increase. Just so we're clear, heating degree day is you take the 65 degrees minus the temperature of that day, and that is the amount of heating degrees that temperature, that day represents. So it's a way of measuring heating demand, basically. It's a little more accurate than just looking at overall temperature or looking at power demand. So December is expected to pretty much be an average December, a little warmer than what we saw last year. I'm sorry, a little colder than what we saw last year, but nothing extreme. January is where the seasonal variance will begin to take hold. It'll hit the west of the state first, or it'll at least be the coldest out there, slowly moving across the state. And then by February, we do expect things to be much colder than average, 3 to 4 degrees. It does look like it will be a very cold February. One thing to keep in mind here is that despite February being colder on average than January will be on average, we do expect January to have more heating degree days than February. So we're still going to look for January to be the prime demand driver. Probably look to see the winter peak this year, not necessarily a new record peak, but the peak for the winter to occur sometime in January, and expect more heating degree days for January than we do expect for February, despite February being much colder than average. Again, just another look at the precipitation here, just much drier than we're going to expect for a typical winter. So here are graphical representations of the heating degree days over the last few years from 2011 up through last winter, and then what we expect for a normal winter and kind of our forecast for this winter. So you can see there the dark gray is around what we are expecting from a heating degree day perspective. So as you can see, for pretty much all of New York, we are below last year in terms of overall power demand, but we're slightly above normal, the normal heating degree days being represented by the lighter blue color. And you can see that we have the weakest variation for Albany, Syracuse coming in February, as once again it is expected to be colder than average. Just a summary of the methodology, looking again at heating degree days, looking for that to decrease into February, again, despite it being much more below average than January. Cold over the eastern half of the country, that's being driven by some ridging in the eastern Pacific, so it's going to keep the warm conditions in the west, and we're going to see below seasonal temperatures out in the east. Weak El Nino supports the overall cold winter, cold anomalies increasing in intensity, and again, heating degrees are going to decrease year over year, as last winter is considered a bit of an outlier. All right, we're going to take a look at our Zone A winter outlook. Due to the expectation of a relatively normal December, we are looking for a bit of an uneventful yet still volatile Zone A. When I say volatile, I'm going to be looking for day-ahead versus real-time congestion variances when trying to figure out if the real-time is going to be more expensive than the day-ahead. I'm going to take a very close look at how virtuals are bidding into the day-ahead. That will be a strong driver there. What we are expecting is IMO to be back on December, came back on December 5th, actually came back a little, they extended it and then brought it back on the 7th, I believe. So with IMO comes back, that does bring back that volatility, bring back that congestion. We still have multiple Niagara Packard lines on outage pretty much, I believe, till the 25th through basically the end of the month. So with those lines on average and with IMO coming back in, looking for quite a bit of volatility. Overall, over the average, weaker pricing, but strong day-ahead versus real-time volatility. So if you're very risk-averse, the day-ahead will probably look a little better for Zone A. But once again, I'm going to be looking at where those virtuals are coming in day over day. And if the virtuals start to get close to zero, then I'm going to expect some steep bearish real-times out there in Zone A. For January, less volatile, still congestion, but more consistent congestion, and also prices coming up a little bit. So we will get those Niagara Packard 115 lines back. IMO is expected to remain strong. Going to get good outputs out of Niagara as demand does rise. We'll go over some bearish line outages in a little bit, and also what could drive some actual Dissinger East congestion. So once again, January Zone A, less volatile, but stronger pricing. February 2015, not a lot of outages posting yet, as it is about 2 months away. However, expect similar results to January, slightly bearish prices, as once again we do expect heating degree days to decrease going into February. Just a look at a typical congestion pattern that we would expect for the winter. Central East will emerge as the dominant constraint. Has to do with the generation in the east of the state. It is pricing off those gas prices that will increase when the heating demand does increase. Also going to look for strong exports out to New England as the Algonquin pipeline. It's a constrained market, so pricing is usually above New York. We did see that flip slightly last year as there was scarcity across the entire Northeast. Not expecting the same level of scarcity, so I do expect Algonquin to continue to price above New York. So we will be looking for strong Central East congestion. So in the day ahead or in the real time, that does bring quite a bit of real-time risk to zones, basically F through K. We'll get into Zone F a little later when I look at some other line outages coming up that I think offer some downside to F, or a relative downside to F, I should say. But overall, going to see the strong congestion costs finding in the east of the state, most likely due to Central East. So here are the transfer limitations that I am watching coming into this winter. So the most striking things that I'm looking at, I'll start at the top there. We do have Athens to Pleasant Valley. That is coming down this month. Also just another transformer out there at Pleasant Valley as well. That's going to derate that UPNY ComEd interface. The reason I think that this is important is where we would typically see Central East. With these lines on outage, that may divert into more of a Pleasant Valley lead or Athens, even Athens Pleasant Valley congestion pattern. So the main difference there is a downside to F when we get Pleasant Valley leads versus upside F when we get strong Central East congestion. In here, another number of other line outages. This is by no means a exhaustive list, just what I was looking at, what I think could have the most impact on the New York power market. Getting down to the bottom there, Niagara to Rochester, Niagara to Kintyre, Those are on those 345 kV system. It shows here a D rate of distant east. That is a significant D rate. I definitely could see that binding if we continue to see strong IMO flows, strong output out of Niagara. Definitely a strong risk that we do get downside distant east congestion. We have also seen very strong downside congestion patterns on the 230 kV system out there in Zone A. When these lines are on outage, just from a reliability standpoint, they need to send downside to Zone A for risk of losing the 230 line, might be overloaded as power attempts to circumvent the outage on 345. And most of the time, we do see that occurring in the real time. So strong downside Zone A real-time risk while these lines are on outage. Just looking into gen outages, as we go into the winter, NYISO makes sure that most of the generation is going to be available. Obviously, the generators want to be available as they do stand to get probably some good runs in. So we can see the expected megawatts on outage. That number does decrease the further and further that we do get into winter. You can see that over there on the right. More line outages that I am looking at, just those Niagara Packard 115 lines, those are going to be up to the 24th. So when those come back, that should bring a little more stability to Zone A, make it a little easier to understand what is going on with the congestion patterns out there. And then once again, just some Pleasant Valley outages all the way from December through the 18th. Again, that's a bit of a downside Zone F risk. Import-export expectations for the winter. Here we see a graphic of the deviation from the total TTC available over that HQ line. So what this basically represents is the amount of power, the availability for Montreal to flow down into New York. So we can see when the minimum temperature in Montreal is above 50 degrees, again, this is Fahrenheit, over here on the far right side of the graphic. When it's above 50 degrees, there's almost no capacity left on that line, meaning that they are flowing power down south to New York at almost full capacity. But as we see minimum temperatures approach zero and turn negative, and once they reach a point that is negative 10 degrees minimum temperature, during that day, we see almost a complete shutdown of the flows coming in from New England or coming in from HQ. Obviously, that's a strong upside upside price risk in terms of day ahead versus real-time variability. I do look for more volatile real times because it's basically the equivalent of losing a nuclear generator. It just thins the supply stack. IMO flows. Starting here on the right, we'll just look at the last 4 years, year over year, and we see strong imports, a strong pattern of increasing imports coming in from IMO. We can see last year, or last winter, 2014, was still the strongest. But if we take a look at the left, we can see that there was a gas event on that Union Dawn trading hub there. So this was, of course, associated with the strong demand that we did see for gas pretty much all year. But this does not correlate as well with what we saw in the northeastern gas market, C2, C6, Algonquin. As we can see that really during the main cold spikes in January, they did rise, but their main, this is basis as well, so this is Union Dawn over Henry Hub. And then we can see as that basis explodes up above $20 and then all the way up to $40 towards the end of February, we saw a major pullback in flows coming in from Ontario. This makes sense as a lot of those units will pull from Union Dawn out there in Ontario. So had this event, and this occurred because of quite a few reasons, one of which being an issue on the Trans-Canada pipeline. Had this event not occurred, then we likely would have seen nearly 1,000 megawatts of imports coming in from IMO for the entire year. But as they did have a gas event, which again is unlikely to happen this year, as heating demand will be less, and also this was a bit of an outlier for Union Dawn, then we should expect even stronger flows year over year. Then just looking at the pattern between PJM, AC, and the New England AC, looking for slightly less imports coming in from PJM, slightly more imports going out to New England. In terms of PJM, again, I do expect last year to be a bit of an outlier. as we did see those MC prices, M3 prices spike, very strong pricing out there in PJM. Not expected to happen again, so I do not think that New York will flow as heavily out to PJM as we did last year. So getting into gas pricing, so below average winter temperatures, some increased ResCom demand will continue to drive strong prices through the winter. So we have the average price M3, Z2, Z6, Algonquin, and TGP Z6 there. So we can see over the years how the average gas has traded, and obviously we can see that the 2014 season was the largest outlier. So this year we're going to be looking for pretty much all of these gas hubs to fall, to basically be the second highest bar on this graph, and all is said and done. Should be well below 2014, but likely above 2013 for M3, above 2011, as overall gas prices are still expected to be strong with the increase in heating degree days from average. One pattern that we did notice last winter, so just due to the rules and the bidding procedure that we do see in NYISO, when a generator bids the day ahead, they are forced to use the prior day's gas price. This is because the bid deadline closes at 5 a.m. Obviously, gas has not even begun to trade for the following day. So the NYISO dictates, and they sent up their reference bids, assuming that they're going to bid in using the prior day's gas. So we do see significant gas drops day over day, but obviously last winter with the extremely inflated pricing, we saw very, very significant gas variation day over day, and we began to see it drive some significant day-ahead versus real-time opportunity. So again, just to reiterate, when the generator bids into the day ahead, it's going to use the prior day's gas, but when it comes on in the real time of that day, it will actually be using the gas that trades for the next day, or for that current day. So the gas that will trade basically the same day, that same morning that they bid in, the gas will then trade that day. If gas trades down day over day, that means the generator is actually operating on cheaper gas. And any generation that needs to enter the supply stack in the real time only will be able to buy cheaper real-time gas than what the day ahead priced off. So again, typically we don't see much of a variation from this, as you know, gas prices don't vary extremely day over day. But here we see, if we look back to last winter, and we filter by day over day gas delta. So that's that column right there in the middle that is gray there. And we look at the top 15 biggest changes day over day, meaning that from the prelim to the next day, 14 of those 15 days have very significant zone G dart spread. When I say dart spread, that means that the real time came in significantly below where the day ahead cleared. So this tells me the generation is not only they're competing their bids down to stay in the real time, but also if additional generation does need to come in, they're able to price themselves into the market and bring the market price down in the real time, as the gas again is likely significantly cheaper than what they're into the day ahead. So some terminology here again, DART, just positive means day ahead, above the real time. For DNI, that is demand net imports. So we take a look at the total day ahead and real-time demand, depending on which market you're looking at, and you remove the imports schedule or the imports actual, and the value that you get there is the total load that has to be met by New York only generation. And we can see in the second to last column here that we have negative DNI DART every single day, meaning that there was much more demand in the real time than was covered in the day ahead. However, due to the extremely weak gas prices, the market was more than able to cover this and still drive prices down. Another note here is when we see the one day that we did, of these 15, that we did have a negative DART spread, meaning that the real time was more expensive than the day ahead on the 8th there. Not only does that represent the strongest DNI day of any of these days, but furthermore, Indian had tripped offline in the real time only. So when I look at those factors, basically 1.3 gig DNI DART, in addition to the loss of a major nuclear unit in New York, I would consider a $40 DART spread relatively light, considering the real-time low that we saw on that day. So this is certainly not a guarantee by any means. Again, as I said, we can see here it works all the way down to about 20%. So if gas goes from, for example, $5 to $4, I'm not going to expect that, despite being a 20% decrease, I'm not going to expect that to drive a significant dart spread. But when we do see the inflated gas prices that we did see last year, we did see it have a major impact on the gas market. And one other point, the average dart spread for Zone G last winter was $12. The 15 days that I have here represent a $56 dart spread. So clearly a variation. Talking a little bit more about gas, we are expecting more LNG for New York and for the entire Northeast this winter. There is an LNG terminal at Everett. The New England ISO is offering an incentive program. They're going to pay back $3 per MMBTU for any unburned inventory. It's pretty similar to what they did for oil last year. They are continuing to do that. So the increased imports from Everett that will go directly into AGT, which will affect downside in New York just by limiting the amount of exports we send in New England as the gas will be cheaper. Also directly goes into TGP, which quite a few generators out there in Zone F do price off of. So overall downside on increased LNG this winter, downside to the gas price, I should say. Getting into oil gas switchers in New York for a little bit. Here we have the EIA total burn data, total quantity of oil consumed for January, February, March, April. We can see quite a few generators did burn oil last winter as gas prices did price themselves out of the market. It became much more cheaper and efficient for them to come in and run oil instead. Here we can see highest quantity in January, where we can see the strongest gas pricing decreasing February, March, and then in April, nearly almost nobody was running running oil anymore. And another thing to look at here, the vast majority of these generators are all sitting right in the New York harbor. That is because oil is delivered and traded directly in the New York harbor, so it's much easier for them to get. They're not going to pay nearly as much as a premium to transport that oil. So when I'm trying to figure out when Unit 3 will begin switching to oil in real time or in the day ahead, I'm going to be looking at C6 gas prices the closest. If you calculate the amount of MMBTU of oil burned in January, that way you can compare it directly to the amount of gas burned. And you can see quite a few units here, Astoria, Roaston, some of the North ports. When they entered East River, especially, when they entered on oil, they stayed on oil for quite a bit of time. So it's not a 1 day off, 2 day off type thing. They come in and they run for an entire week on oil once they commit to switching over. A little bit about where we expect oil to end up this winter. As of right now, it is trading 35 cents per gallon below its 5-year average supply in the market right now. As we said, it would be the marginal unit in New York City quite a few times last year once that C6 price did trade up. So with this weaker oil price, I am going to look for them to switch to oil at a weaker threshold than we did see last year. One other thing is we are expecting the return of Genscape. Genscape is a relatively large unit out there in Zone G. It was mothballed after Sandy. Basically the basement flooded on the river there. But it was rebought and is being refired on natural gas. It is east of Central East, also south of Pleasant Valley Leads. So I do look for this to be a strong or to reduce the amount of congestion day over day. So it's being refired. 4 units will total 530 megawatts. So that's year-over-year additional generation to the state. And they are capable of switching from nat gas to oil or even coal. So once again, it will help reduce the pricing when we see strong gas prices, that they will be able to switch to oil. And you can see they're right next to Roaston and Bowline, both of which did run on oil last year. So I do expect them to run on oil if prices get out of control once again. So quick summary of what we're looking at for this winter. Demand below average temperatures, above average heating degree days. It's going to be less than last year, but still above average. No polar vortex. Imports from the north will be cut when the temperatures get near zero. Dips below 10 degrees, we didn't expect some exports. We're going to look for stronger IMO this year, as long as there's no significant issues with that Don Hub basis swap once again. Fuel imports, again, strong gas pricing, but less than we expect. less than we saw last year, probably more than any other year, though. Generation is switched to oil a little sooner than we typically see. Transmission, mainly I'm looking at the downside zone A risk. Mainly I'm looking for that to be a real-time only event, as I was speaking about previously. Also, increased plausibility leads than we would typically see over a winter due to the outages I also mentioned. Generation, return to dam scammer, so a little bit downside of the usage state there. Here's just a visualization of basically the information that I just went over. Load bullish, generation is bearish, transmission is mixed, gas is going to be bullish from an average perspective. Imports pretty much neutral as the increased IMO will offset the expected loss of HQ and TJM and New as well. So getting into a bit of a product overview, what we offer here at Genscape and why we're all here to help reduce some of those costs and manage risk going into the winter. It's a product called Power Buyer. So every day we do day ahead and real-time price forecasting. Look at a number of inputs. We have a generation-driven supply model here. So we have all the units, all the bids unmaxed, and all the heat rates set for all of the generation in New York and for any market that we do cover. So all of the generators for any market, or the vast majority of which at least. We have heat rates set, so the fuel price we are expecting. We also run demand scenarios. We have an in-house team of meteorologists here who run custom demand scenarios for us. And we go through and we dispatch units economically, and that is how we arrive at our price forecast. So unlike a number of our competitors will use a statistical model to arrive to a certain price for a certain day, we actually dispatch that generation economically. One of the major benefits that we do get for the New York market is we are able to do zonal price forecasts very well, as our model is able to forecast congestion and actually binds constraints properly, and will dispatch generation and prices appropriately around the constraints that we are expecting in the market. So what Power Buyer does is it takes the two scenarios we run. We run for the day ahead, in which we use the estimated day ahead clear demand, and then we take another scenario and we run for the real time, which we use our in-house real time demand demand expectations. We also switch up the supply stack to represent what the real time supply stack will be, and we run it for all 24 hours of the day. And obviously we get two different prices, and those two different prices make up what we forecast as the dart spread. And then there is a risk-adjusted strategy. Basically, we look at what we expect, how much the real time is going to come in below the day ahead. We also look at the upside risk scenario that we did run for the real time. So we take the exact same model that we ran, we add about 500 megawatts of load, and if the percent increase in the real-time price with stronger than expected load is above a certain threshold, then we recommend joining dam for that day. Now, this is primarily designed for power retailers. It takes a relatively conservative approach to day ahead versus real time. You know, as we understand it, quite a bit of retailers are always going into the dam to really just hedge how volatile the real time can be, which is absolutely understandable, a very smart move. But we believe here that we have isolated some factors that will drop real-time pricing. So it does give you the opportunity to save quite a bit of money. So just going forward, talking a little bit more about our process over here. As I mentioned, we do have in-house meteorologists. We are much more accurate than ISO New York. We are more accurate than every ISO that we do cover. Just here is the mean absolute error just for the month of November. We can see that ISO missed by an average. The average daily error was about 2.91, so a 3% error on where load actually came in. We only missed by about 1.3%, so more than 2% more accurate on average than the demand forecast that you are getting from NYISO. If you look at the bottom right, that is the next day made, and you can see quite a bit of variation other than accuracy from that NYISO forecast, whereas for Genscape you can see it's sitting right around that 1%, much less volatile day over day. If you were trying to decide if you want to go into the day ahead or the real time, proper real time load forecasts are absolutely vital to your ability to properly determine whether or not the day ahead will come in between the real time. it is without a doubt the #1 driver of day-ahead real-time volatility. So a little bit more with the Power Buyer, you also get access to our 14-day forecast. So we are doing these load forecasts for New York 14 days out, all the way down to the bow day. So with this, you will get the, as we can see here, NYISO only provides their forecast out 7 days. We provide it out 14 days. So if you're looking bow week, you're looking next week, 2 weeks out, we're able to provide you demand curves, 24 hours, what we are expecting. And for that first week, where we actually have something from NYISO, we'll show you what we are expecting to be the variability between us and NYISO. Again, day-ahead versus real-time demand variability is going to be the #1 driver or #1 risk in terms of picking the day-ahead or the real-time market. On top of that, you also get our climatology comparison. So you're able to look at the 14-year average for a particular day. So if you're offsetting your power cost week over week and you want to know if you're getting a good deal or if it's going to be more expensive than what you paid for last year or should be less expensive, or if you got burned last year on a certain week and you want to see how it's shaping up, or if you're checking out, even about a month, you're considering offsetting through some sort of contract, we're able to show you 14 days into that month, and then you can say, relative standpoint, say it's going to be warmer, colder, more demand, less demand, and that will help you at a lot, really reduce your risk when you're looking to offset these longer-term contracts. Just taking a look at one day, this was for yesterday, the total Power Buyer P&L for Zone J. As you can see, it was a very bearish real-time. It did come in more bearish than we were expecting, but our model did pick up on the downside risk. So you can see here through the day, so on the top is the Genscape forecast. So this, I also forgot to mention, this was released on 12/8, so it does give you adequate time to either buy your power day-ahead real-time, bid your unit to the real-time. Gives you plenty of time to hedge yourself before the bid deadline does close for New York, which is very challenging because, as I'm sure you all know, New York is the quickest one. You basically have to make your decision 2 days in advance. So we do both our day-ahead and our real-time price forecast and all of our demand forecasts, estimated your day-ahead clear, estimated real-time actual demand with plenty of time to take action on those days. So just looking through what the model recommended here, you can see a combination of day-ahead and real-time was recommended as the morning peak really began to ramp up that on-peak hour ending 8. It did recommend going down as a risk, ended up coming in a little below our forecast. So actually was a more real-time, but then through the middle of the day, it did recommend going into the real-time, and we picked up quite a bit of P&L as prices came in very, very bearish. We did miss that spike in the middle of the day. And then going towards the end of the day, hour ending 19, the model wanted to get back into the dam slightly, the market actually did. But then we do recommend a dam buying strategy, hour ending 20 through 21, and that's exactly when we did see the time spike up above the day ahead again. So as we can see here, it is a conservative strategy. We are watching the what we expect to be the main spikes through the day. That is where we get most of the real-time variability. It was looking for some spikes through the day that ended up not happening, hour ending 16, for instance. It did miss that one, hour ending 13. But over the idea here is that if you look at the entire strategy through the entire day, overall buying power when or in the market that Genscape advised for each hour would cost you about $40 on the average for Zone J. The day-ahead price was $46, so you would have saved 13% rather than just hedging yourself out completely for the entire dam if you had taken the Genscape strategy. This is just for Zone J. Also forgot to mention we do offer all of the price forecasts, Zone A, G, J, and K, and that is both preliminary and day-ahead and real-time as well. So that pretty much sums up everything I do have for you today. If you have any questions, if you would like to trial that Power Buyer product, we will talk to you on the phone throughout the day or when we release it as well, so we can advise you directly. If you have a specific node, if you're operating a specific generator or you're buying power in a specific place, then we can speak to that rather than just give you the zonal forecast. So I'm going to wait a few minutes. Take a look. If you have any questions, please go ahead and put them in the box now, and I'll be back in just a minute to answer those for you. Thanks. Right, so we do have some questions. One person asked, when does the report come out? So as I said, 2 days beforehand, and it comes out in the afternoon to get it out around 4 o'clock. So that gives us plenty of time to take a look at everything that's going on in the market for the BAL day, make sure we have all of the generators covered, gives us enough time to accurately forecast both the day ahead and the real time. Also gets it to you with at least about 12 hours to take action on that information. Also, somebody wanted some clarity on the gas. Overall, once again, year over year, gas prices are expected to be bearish. So it's going to be cheaper than last year, but it will be more expensive than the average just because it's going to be a little colder. So those are pretty much all of the questions that we did have. Once again, if you would like to trial any of our products here, we also offer these products for PJM and ERCOT as well. We do have a real-time first day ahead for MISO and SPP as well. So if any of those regions interest you, please reach out to us. If you have any questions about things going on in the day ahead, you just want somebody to talk to you, explain things to you, we'll set up a trial, and we'll reach out to anybody who responds. So thanks for coming, and good luck this year. Bye.